Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update today, following up on yesterday's update after Ben Bernanke spoke. Of course, if any of you have watched the actual news about the testimony from the central bank and their feelings and what they're doing, you'll realize that Ben Bernanke basically said yesterday that not only will they keep rates low until 2015, but they will probably keep them low until we see unemployment around 6.25%. It may be a long time before we see 6.25%, but in essence what this means to bond investors is you're taking probably one of the biggest risks in certain categories of fixed income or bonds, like long-term treasuries and long-term munis, whether those are individual bonds or those are bond funds or bond ETFs. I fear there's too many investors out there who are being sold by their broker, so-called advisor, what they want to hear or what they want to be sold that they perceive to be safe. Bonds have just as much risk, if not more, under certain circumstances as the equity market. So don't fool yourself as an investor and don't be told, hold on, things will come back. There are times you do not want to own certain sectors of bonds for fixed income, especially today, intermediate and long-term dated bonds almost across any category. There's other areas in the fixed income department that would be suitable today. That's why we run our relative strength ranking, and that's why we do the financials on all of these investments. Your decisions about your portfolio as an investor, and I stress this to all of our listeners, not only of our TV show but our radio show, is you cannot make decisions without an investment strategy. Your investment strategy moves you back and forth into areas that are appropriate when appropriate for your portfolio. Emotions are not a good decision maker. I have literally received dozens of phone calls from our radio show listeners, distraught, concerned about the fiscal cliff and what should they be doing. And I keep telling these people, you have to have an investment strategy, because you hear the term fiscal cliff, which is a good media buzzword, and it makes you nervous. Bottom line is, we're not falling off a fiscal cliff. The world will not come to an end if the fiscal cliff comes and goes at the end of the year. Don't expect the equity markets to drop 50% because we roll over the fiscal cliff. It really is a moot point, in my opinion, and all it's really going to do is it's going to force our government to reduce the budget and spending and actually raise taxes across the board, which actually wouldn't be all that bad. Don't expect catastrophic events from the fiscal cliff. Again, this is the media that is trying to hype a situation that needs to be addressed, but it's not going to be earth-shattering, and it's not going to take us all to the big dark hole. I would argue that you need to take the emotion out of your investment decisions. You need to follow an investment strategy. If you or your advisor is not doing that, or you're finding you don't really have an advisor or money manager, call our firm for a consultation. We always like taking on new clients who are good to deal with, who want to improve their situation. But please, don't listen to media hype. Don't make bad decisions with your investment portfolio. 2012 is coming to an end. Ultimately, when Ben Bernanke spoke, we saw exactly what I anticipated. Gold started moving up higher. By the way, we do own gold, fair disclosure. I looked at the emerging market economy, started to show even more upside potential. We've owned those for a while, by the way, fair disclosure. We've seen some of the areas in the U.S. equity markets do well, and other areas of fixed income, not necessarily the muni bond or treasuries, but other areas in the fixed income like preferreds, like emerging market bond exposure, do well. So at the end of the day, a sound investment strategy, which includes risk management in severe down sectors or markets, is going to be more important than ever. Don't be a buy and hold investor. Don't be sold what your advisor broker wants to sell you to give you the warm and fuzzy, because that could be exactly the biggest risk you've taken in your investment portfolio in your lifetime. And I fear too many investors today have overloaded the boat on long-term munis or intermediate munis and government bonds, and one day you're going to be open that portfolio and you're going to realize you could be down 30 or 50% depending what happens with rates. Bonds have a lot of risk, and in my personal opinion, they have very little return going forward on most sectors and very much downside potential in your portfolio. Rethink what you're doing. Don't buy what you perceive to be safe. Follow an investment strategy and make sure you understand what you're buying and when you're going to sell it, so you can control the risk in your portfolio. Have yourself a great holiday season, and of course, again, call our office for a consultation if you'd like to become a client, if you're tired of bad investment advice and the conflicts of Wall Street. Have a great holiday season.